Hello listeners, welcome to Money Talk with Patrick. I'm your host Patrick, trading mentor and creator of TC Trading. In today's episode, I will be talking about the difference between assets and liabilities. There are important misconceptions when it comes to them, which I will explain with some examples. If you know anyone who's interested in personal finances, investing, or trading, let them know about this podcast. Sharing the podcast really helps me reach new people and help others. So hello everyone, how is it going? Happy Thursday once again. I hope that you are doing great. Now I want to talk again a little bit about personal finances because I think this is such an important topic, mainly for the younger generations. We're talking about millennials, we're talking about Gen Z who might not really know a lot about money or who might not really know about investing, about trading and all these kind of different ways that you can diversify your income and actually make more money. Now, one of the things and probably one of the books that I always recommend new people who are interested in this or who ask me, hey, how can I learn more about finances? How can I learn more about investing? The first thing and the first book that I always recommend is Rich Dad, Poor Dad by Robert Kiyosaki. Now, it is a tremendous book if you go and read it. I mean, this is kind of like one of those books that I label as must read. You really need to read it at some point in your life. Now, I will explain a little bit about the topic, which is, of course, assets versus liability. But in order to understand the importance of it or why an asset differs from a liability, you really have to understand the underlying concept, which is a keyword. And this keyword is cash flow. Now, cash flow is pretty much everything, If you are building a company, if you're trying to save for a specific thing, if you're trying to invest in something, cash flow is gonna be kind of like a key concept that you need to understand in order to analyze how good you're doing in your business or whatever you're doing, right? Now, cash flow refers to the amount of money being transferred in and out from a company or an individual, okay? Of course, you might be thinking like the company receives money, the company has some costs, of course, money flows in and money flows out. On one hand, again, you have in your specific scenario, you might have your income, right? You might be working at a company, you might be having a part-time job, whatever it is giving you money, Again, it's making so that money flows into your wallet. And on the other hand, you have expenses. You have to pay the mortgage. You have to pay for your food. You have, maybe you want to go out and, do whatever hobbies you want. Whatever you have to do or you want to do, it's an expense and it's taking away that money. So it's essentially money is flowing away from your wallet. And the most important thing here is knowing your net cash flow. Okay, so what's the net cash flow? It is the overall income that you receive or costs. So for instance, if your overall income is bigger than your expenses, or you are having more debt and costs than your income, then this might affect whether your cash flow is net positive or if it's net negative. If your net cash flow is positive, you should aim to save and potentially invest. And if your net cash flow is negative, the first thing that you should do is basically aim to pay your debt or whatever expenses that you're having. Of course, the only way to get a negative cash flow really is if you are almost having debt. Maybe you have savings, but of course, if you have savings and you have a net cash flow that's negative, then you might run at some point in the distant future or maybe in the near future of those kind of savings. So it's very important, and this is such an easy concept to understand. How much am I getting? Am I getting more than I'm spending? If I'm spending more than I'm earning, then what are my total savings? This is when you can start kind of like doing predictions in the future. If you're spending at a rate that's greater than your income and you more or less know how much that is per month, then you can make a prediction of when are you gonna run out of savings. Or maybe you can do kind of like the opposite, right? If you are earning more than you are actually spending, then you can potentially be aiming. If you want to save for, I don't know, a house, if you want to save for for a business, then you can actually forecast, okay, this is how long it will take me at this rate, at this specific cash flow to get to that specific goal. I hope that you understand cash flow. It's very easy to understand, but again, it's very important, and it's always essential to be thinking about this whenever you are in personal finances or even for your business. Now that you understand cash flow, let's define what an asset is. So an asset is an item, okay? It's an item that you own that can provide future economic benefit, and this is very important, future economic benefit. A more simple definition is something that puts money into your pocket or into your wallet, creating a positive cash flow. So things like having a profitable business, rental property, art, or income from investments are considered assets. Now, bear in mind that these definitions will agree to personal finances only and not necessarily to accounting. For the purpose of accounting, a company may list a lot of assets, even though they don't really provide more money or benefits to the company. So it's really important to kind of like differentiate how you would see this from an accounting perspective and how you should see it from a personal finance perspective. Definition of liability. Liabilities are what you owe to other parties or items that take economic benefits away from you. And here, of course, the keyword is take economic benefits away from you, basically referring to anything that takes money out of your pocket, out of your wallet. Now, these are things such as going on holidays. You have vacations, you want to go out. All those are basically liabilities or costs. You are talking about clothing, you are talking about eating out, etc., etc. They are all considered liabilities. And once again, bear in mind that this definition will be true depending on the outcome of the liability, because it is possible to have what is called a good debt, and you might say debt is always bad. Well, that's not really the case. Sometimes you can actually have good debt, which is basically a debt that is actually creating a positive cash flow. And you might think, oh, how is this possible? Well, maybe you take a specific loan for a business and that business starts being profitable, then essentially that that liability is gonna be part of a bigger asset, right? And thus, you will only take it as running costs. But if the overall business is positive, if the overall business is profitable, then you wouldn't take that as a liability. Now again, here for accounting, none of the liabilities will be accounted for wealth creation, and this is because of the balance sheet, because you have to take care of whatever debts you have versus whatever assets you own, so that it must kind of like equal zero, or it should be equilibrated. And again, don't worry too much about how this looks in terms of accounting. Worry more how it looks for you, for your personal finances. In any case, just to finish kind of like talking about these different concepts, what I want to talk about is some misconceptions that you might have heard or that you might encounter in the future. So the first misconception, the first big mistake, is naming things that you own as assets, okay? When in reality, they are liabilities. So you really need to take into consideration if they are assets or if they are really liabilities. So things such as a business, things such as a house, a car, they can be both an asset or a liability depending on the cash flow they generate. And this is why I'm highlighting cash flow, because that's the keyword that will let you know whether something is an asset or a liability. If a business does not provide income, if a business is just consuming your resources for a long period of time, it might become a liability, or more than anything, it is a liability. Of course, maybe in the future that specific business starts working and it moves or it transforms from being a liability into being an asset, but only until it is actually being profitable. And here I'm not saying don't open a business. Here I am not saying don't risk and if you have an unprofitable business, just stop it. Of course not, because if it has the potential to bring profits in the future, then having that liability might be worth your while, okay? Now let's take a second example, a car. A car would usually be more of a liability, because most of the times you won't need a car, and it's kind of like a nice to have. You can always use public transport, you can always do a lot of things, right? Some of the times, for modern businesses, with modern business models, you can allow, having a car to become kind of something that directly gives you some kind of income. Mhm. You have things like Uber, or you can even rent it out, which I've realized that it's a big thing here, for instance, in Canada, where you can actually rent out your own car. So again, this will create a positive cash flow, and if it creates a positive cash flow, then that liability becomes kind of like an asset. And I know what you might be saying: what if I need that for my job? Then of course it's gonna kind of like form part of an asset, because ultimately it's actually making you earn more money. But here's what you need to think about: is the car that you're owning more expensive than what you actually need? If so, then it might be a liability instead of an asset. Now, the very last thing that I want to talk about, and potentially a very controversial one, is: what is a house? A house, do you think it's a liability, or do you think it's an asset? Now, if you don't rent it, and if you still have to pay mortgage, if you still have to pay insurance, if you still have to maintain it, and you have a lot of costs, then of course it will be more of a liability than it is an asset. Now, people might think that the price of houses always go up, but this is not necessarily true. Just think about the housing bubble in 2008, 2007, 2008, 2009. All that debacle pretty much let us know that a lot of people lost their homes. Why? Because they couldn't afford their mortgages, right? And this is why the price of houses don't always go up. And there's, again, a lot of people that say that, well, the population is ever increasing, and they refer to the laws of supply and demand, which of course it's true. If there's more demand and there's a limited supply, well, guess what? Of course the price is gonna be trending to the upside. It's gonna try to go up. But now, if you are talking in practice, if you look around at what's happening right now, you see that houses are less and less affordable for younger people. And actually, when I was posting in LinkedIn, because I made some analysis regarding the housing prices in the last, I think it was 20 years. And if you compare the last 20 years to what they are right now, houses are twice as expensive. And this is accounting for inflation. So if you take out inflation into consideration, they are still twice as expensive. And if you look at how much people are earning right now, again, already considering inflation, you are not having that. So this practically means that housing is less affordable for millennials. Housing will be less affordable for Generation Z. Now, what does this mean? Is that they are actually not gonna buy a house, right? They're gonna potentially rent it, because they might have other types of debt, like student debts. They might have, I don't know, credit card debt, whatever, and maybe having a house on top of that is not such a good idea. Now, why I'm saying this, because again, people think that housing and houses will always go up, but they have to take a little bit of consideration for what might happen in the future now, right? Another big thing is that the pandemic has shown us that remote jobs can be a reality. Therefore, why would you pay a huge premium for living in an expensive city like Vancouver, like London, where you could potentially work from somewhere else that is way cheaper and way affordable, that you have to pay way less, and you are gonna be basically earning the same? So these are things that you need to consider when thinking, okay, a house, is it either an asset or is it a liability? If you have a house, if you are paying for a mortgage, but you are also renting it, and then whatever you're renting it for, it's actually a little bit more than what you're paying for, guess what? Then that becomes an asset. But for the most part, and for most people who live on their own house and who have to pay the mortgage and who have to pay the insurance and all this will be a liability. In any case, traders and listeners, I hope that you enjoyed this episode of Money Talk with Patrick. Maintaining a positive cash flow should be the priority of your personal finances. Even though I am not a financial advisor, keep in mind that you may be better off avoiding liabilities and trying to get more assets. If you are listening through Apple Podcasts, I would really appreciate if you could leave me a review. Thank you in advance. Thank you very much for listening, and I will see you in the next episode. Take care.